Hello, everyone. I am David Schlossberg, a partner of Assured Concepts Group. I want to walk you through a high-level overview of what the markets have been doing. I'm sure that you haven't been hiding in the closet and that you've seen that things are not going really well for the markets. We're actually off to the worst first three quarters in a year that we've seen in a long, long time. And I want to walk you through some of the things that are impacting the markets, our portfolios, and mention some silver linings that we might be optimistic about into the future. So I'm going to talk you through some of the information in these slides, and I'm going to share that screen with you from Lincoln Investment Advisors called the Market Intel Exchange. I know the three big things on the minds of my clients and on most investors are these issues: inflation, the Fed policy and interest rates, and the midterm elections. We all know that inflation has continued to skyrocket, and we're now starting to see a very small downward trend in the inflation since the peak that occurred in the summer. We've been seeing the inflationary impact as we're buying goods and services, and the inflationary decline is predominantly a retraction of the otherwise surging oil and gas prices. Most would suggest that the release of oil from the strategic reserve, along with a reduction in gas consumption, has helped. But with OPEC deciding to reduce production, this pullback of inflation may possibly have only been temporary. We're yet to see. The drawback on the chart has not been enough to make the markets happy at this point. And it's certainly not enough to make the Federal Reserve happy. The Fed needs to do everything they can to get inflation under control, and they've been incredibly hawkish on their position to fight inflation. They effectively, they said that they're going to do all it takes at all costs. And as you can imagine, the stock market doesn't like that. The silver lining is that the data driven around inflation is lagging. So today might not be as bad as some of the data that's being reported. But I actually think if you look back historically, based on where retirees are spending their dollars, you may have actually experienced inflation higher than the 9.1%. I think as long as we continue to see a downward trend, my hope is the Fed does not get too aggressive with some of the future rate hikes. If the Fed pulls back on some of the future expected rate hikes, then that could be a good thing for the stock market. But that is only possible if some of this inflation wavers. It's going to be a wait and see game on what the Fed actually does. A couple things that I want to share with you is that the midterm elections, as they approach, one thing that we might be a little optimistic about, although history does not always repeat itself, but if we look at all the years of the stock market that are not in a midterm election year, so all these years, here I'll annotate this for us, all these years, if we look at all those years that we were not in a midterm election, we actually saw the market go up quite a bit. If we look at the years, the average midterm election year, we actually saw somewhat flat rate of returns or maybe even declines leading up to the election time period. And then when the November time period occurred, we saw a pretty significant upslide in the markets after that. Again, this is an average since 1931, so some years would have different results. While history does not always repeat itself, this information is a cause for potential optimism. If I move us to the next slide, we'll see, I better get rid of those annotations. You'll see that what happened in every election year dating back to 1950. The only year that somewhat lagged was 1986, and when the market return in that year in the 12 months following the midterm election was only 1.1%. But the average year following the midterm elections was 15.1%, which is double the rate of return of all other years. Interestingly, again, there was not one down period 1 year after the election occurred, dating back to 1950. So there's some interesting viewpoints out there. The midterm election year being twice what the other years was is pretty interesting from my perspective. So there are some interesting viewpoints out there. You can go and download this report from Lincoln Investments. You'll find it available on our website. There'll be a little bit more data out there than the particular slides that I'm choosing to share. This slide that we're looking at now suggests that the majority of respondents expect 8 more interest rate hikes from the Fed through the remainder of 2022 and the entirety of 2023. That's over here. The respondents are asset managers from various fund companies, and 47% of the group think that we're going to enter a recession in the next 12 months. On the flip side, if the glass is half full, that means that 53% suggest we are not going to enter a recession in the next 12 months. But half think we will experience stagflation in the next 12 months, which can be viewed as worse and definably more difficult for the Fed to respond to. Inflation is typically caused by strong consumer demand coupled with a weakened dollar. Pumping more money into the system weakens the dollar, such as all the pandemic stimulus efforts did. But stagflation is inflation coupled with a weakening demand and an overall economic slump, where the demand is not the cause of the inflation. The Fed raising interest rates is supposed to weaken demand as interest rates cause purchasing to become more expensive. If the inflation is caused more by supply side problems, a lingering inability to get products to market, raising interest rates may not have a similar inflation controlling effect. The term stagflation actually got its name during the 1973 to 75 recession. Many speculate the cause of stagflation to have been the 1973 oil embargo, where oil prices quadrupled at that time. So oil being the culprit then, and hopefully it's not the culprit again. Ranking in the order of things that would have the largest positive impacts on the equity markets, the most important of those would be Fed policy. Like I said, if they start to see inflation trend downward, they might slow down their interest rate hikes, and that would be a positive move for the markets. If we start to see inflation come under control, number two, that also would be a positive move for the markets, in part because lower inflation will create a more robust economy, but that would also impact the Fed's policy position. If we start to see supply chains open up, that would probably also be a positive move for the markets, but again, because this will impact the other items above it in a positive way. A greater supply chain would reduce inflation and cause the Fed to take a step back on its proposed rate hikes. And if there's positive movement with the Russia-Ukrainian war, some of the geopolitical risk would become reduced. That would ultimately be a positive move for the markets as well. When we look at the overall economy, here's some key economic and market metrics. Consumer sentiment is below the normal range, but it's currently increasing. Economic growth is in the normal range, but it looks like it's on the decline. Inflation, as we know, is all above the average since 1947, and volatility is towards the peak, but within the normal range, while unemployment is still towards the bottom end. Something we'll keep an eye on is the 10-year treasuries. They are actually in the lower end of the historical range, despite the recent increases. Another slide that I want to touch on real quick is this one. Since 1996, we know the markets has had its ups and downs. If we look at the down percentages, we'll see 49%, we'll see 57%, we'll see a 34% decline, and we'll see currently a 25% decline at this point. If we look at the up periods, we'll see a 106% increase, we'll see a 101% increase, a 401% increase, and then a 114% increase, respectively. The ups more than double the declines. What we have to keep in mind is that if we lose 50%, we need a 100% gain to get back where we started. So if we have $100, we lose half of that, we have $50. We need a 100% return to get the $50 back to $100. The trick is once the bear is identified, the bear market that is, to make risk-reducing portfolio modifications and attempts to mitigate a portion of the down market. We refer to this as a risk-off modification. Of course, we cannot necessarily eliminate all risk, but the intention is to mitigate risk while affording some possible upside opportunity when it occurs. And then once the bull is identified, to effectively go back to a risk-on environment and capture a larger portion of the upside. The next slide that I want to show you all has to do with diversification domestically versus internationally. If we look at the last 10 years, whoops, one slide too much. If we look at the 10-year period between 2010 and 2019, we'll see that the domestic markets outperformed. In the 10-year period before that, we'll see that the international markets outperformed. And then in the decade before that, the domestic outperformed. And in the decade before that, international outperformed. There's no crystal ball when one's going to outperform the other. So there's no way to tell what's going to happen next. None of us have the crystal ball so that we can predict one versus the other. So the key, of course, is to be diversified and to have some international exposure at all times. If we look at the time frame from 1976 through 2021, a portfolio that was 60% equities and 40% bonds or fixed income, we'll see that during that period of time, the average portfolio in that mix gained 10.9% as a historical average. We were generally in decreasing interest rate environments. If we look at expectations of some of the largest managers in the world, JP Morgan, Goldman Sachs, BlackRock, and State Street, they're projecting over the next 10 years that a 60-40 portfolio will return about 5.3%. So that's their consensus, and it's broken down stocks versus bonds in the chart on the right. While these folks' crystal ball also doesn't typically work that well, what they do makes it very important for us to think about in projecting financial plans for our clients in retirement. With the historical returns, one might suggest that a diversified portfolio can expect almost 11%. But I would challenge any advisors who's illustrating a return of that nature on a going forward basis. I think we need to be more conservative and more realistic. The last item that I want to show is one's response to the market and one's response to volatility, because there is no doubt that we're in a highly volatile market right now. One's response to volatility in their portfolios matters immensely, and I want to talk you through a story of 4 different investors. We'll start with an apprehensive investor in light blue. This is somebody that took the decline in 2008, decided they didn't like the market volatility, and they went 100% to cash on January 1st in 2009. They stayed in cash that entire period of time, so for 12 years, they weren't willing to take any market risk after the decline of 2008. They would have $6,151 remaining in their account. After them, next is the gray investor, who's the uncertain investor. They moved to cash at the start of 2009, and then they waited out 2009 and they reinvested 1 year later, January of 2010. For this investor, his $10,000 investment would be worth $26,070 12 years later. After that, we have the steady investor. The steady investor stayed the course. They made no changes to their portfolio. They rode it out. They stayed in it the whole time. They never made any changes. They never sold. At the end of 2021, they'd have a bid over $32,000. But lastly is the opportunistic investor. They started with 10 grand, and then during the financial crisis, they said to themselves, this could be a once in a lifetime opportunity. They added another 10 grand at the start of 2009. And by simply doubling their investment when the market was looking pretty sad, their value at the end of 2021 would have been over $85,000. So unfortunately, A lot of our clients are retirees and they're unable to add and to be opportunistic. But I simply show this chart to help calm some panic that might otherwise be there. Everybody has the ability to be a steady investor. For our clients, we will always consider the market and make adjustments accordingly. And while we may adjust down the risk levels, we always want to consider the steady investor in our mind, trying to mitigate a portion of the down while attempting to capture a good portion of the ups. That's what we try to do on behalf of our clients. I hope you find this message of value to you. And should you have any questions or concerns, I invite you to reach out to myself or my staff, and we'd be happy to discuss those matters with you. Thanks for watching the video. Have a great day.